Hi, everyone. Good evening. Can everybody hear me? Okay, so it's 5:30 right now. So before we kick things off, I'd like to remind a few things. So my name is Karen. I'm a marketing coordinator at the credit union, and I'll be your facilitator for tonight. So before we begin, I'd like to thank everyone here for joining our webinar, and we'll be sharing helpful tips on how to use your home equity to your advantage. So just a quick note, some participants who signed up for tonight have questions about the reverse mortgages. Sorry. So if you're one of them, we sent out a separate email about this, but just in case you missed that email, I'll mention it here too. So our host won't be covering reverse mortgages tonight since the credit union doesn't currently offer it. So that was an error on our end, and we apologize for the mix-up. However, our host will primarily discuss HELOC, home equity loan, and refinancing. And also, I would like to remind everyone to please turn off your mic and camera during the presentation. The webinar will be recorded and will be sent to everyone the next day. And lastly, we'll have a Q&A session at the end of the presentation, but if you do have any questions that you think about as we go along, please feel free to share them in the chat box and I'll read it to our host. Or you can wait till the end and you may unmute yourself and ask your question directly to our host. So I encourage everyone to take this opportunity and ask their questions. Okay, so before I kick things off, I'd like to introduce our host for tonight, Jennifer Bernier. Jennifer has been with Clark County Credit Union for 25 years, specializing in HELOCs and helping members find financial solutions. Jen loves turning tough financial situations into success stories, and seeing the relief and gratitude from members is the best part of her job. With a bachelor's degree in business management from UNLV, Jen brings both expertise and heart to everything she does. And outside of work, you'll find her camping with family or cheering at a baseball game. So, with that, I'll have Jen take over the floor now. Jen?
Hello, everyone. Welcome. Thank you for joining us tonight. So, we're going to go over home equity lines of credit. We'll be defining some things. We'll be just talking about what might be the best situation for you. And then, like Karen said, if you have any questions, you can certainly put those in the chat. So, the first thing we're going to talk about is how we define equity in your home. So basically, the difference between what you owe on the house and what the house is worth is your equity. How we determine how much equity you have to borrow, because the credit union doesn't give you 100% all of the equity that's available. We're limited. And so, how we determine that is we will, for example, 80% loan to value is the highest we will lend on a home's equity. And how you figure that is the value of the home times 80%, that figure minus what you already owe, because we will allow you to owe 80% of the value between the mortgage you already have and the home equity combined. So that's how, and you know, you'll call in and we'll figure all that out for you. But, excuse me, so if you're unsure and you don't know, we'll give you the phone numbers at the end of this. You call us. You can give us all your, personal details, and we'll figure that out for you. The best part about borrowing against the equity in your home, in my opinion, is that you are able to borrow money at a cheaper rate, interest rate, and payment than other kinds of loans that are offered out there. There's tons of personal loan companies that are out there. The credit union does those as well. However, if you own a home, if you have equity in your home, this might be a better solution for you. Okay, there we go. How the home equity is calculated. So, I think we went over this already. Yes. So we have to get the value of the home and then determine, well, we won't necessarily have to do a full appraisal. The credit union has software we use to get a really fast value on the house. As long as it's large enough for us to do what you guys need us to do, then we will use that value rather than getting a full appraisal. So full appraisals are not mandatory. There are certain situations where we would request one, but not for everyone, which saves on fees, which is fantastic. Okay, so the home equity line of credit is a second mortgage, guys. So if you already have a mortgage, this would be a separate second mortgage on the home. It is a higher rate. Well, for sure, it's going to be a higher rate than the mortgage you already have currently because all of us mostly have a mortgage with a really low interest rate, which is why nobody wants to touch their mortgage. They want to leave that separate to a separate second mortgage, which is what the home equity line of credit is. So for anyone wondering, does this affect my first mortgage at all? The answer is no. That stays exactly as is. You continue to make payments exactly as you are doing. Your rate doesn't change. That loan changes. It does not change at all. So this is going to be a separate loan from that. If you have no mortgage on the home, I'm jealous, but if you have no mortgage on your home, then this loan, we can still do a home equity line of credit. So, yeah, for anyone worried about will this affect any terms of your first mortgage, the answer is no. Fantastic. Okay. So there are two different kinds of home equity loans that the credit union offers. So there is the home equity loan, which is what you are seeing now. It's an installment loan. So we still borrow against the equity of the house. It's still separate from the first mortgage you already have, but it is an installment loan, meaning when we fund the loan, you get the entire amount right up front and you make payments on that amount from day one, whether or not you've spent the money, right? So the home equity line of credit, for example, or I should say, on the other hand, the features that I like better about this is number one, it's a line of credit for the first 5 years of the 15-year loan. So payments are amortized over a 15-year loan. The line of credit is open for the first 5 years of the 15, meaning in that time, you will take what you need as you need it. You make payments only on what you are using. And then as you pay down the loan, you can access this money again in that first 5 years. The interest rate is determined by your credit score and the loan to value. So it is tiered to credit score and tiered for loan to value. It is based on prime. So the interest rate is variable based on Wall Street Journal prime, which the Federal Reserve, they set that rate. We just follow it. So it's based on prime. And so when the feds get together, if they get together, it's typically like quarterly-ish. So when they get together, if rates change, your interest rate can change. However, the credit union does have rate caps. We have a 2% cap per calendar year and a 5% cap over the life of the loan. So the rate cannot move up or down by more than 2% in one calendar year and never by more than 5% over the entire 15 years. So these are not, you guys, the variable rates from years and years ago. So don't worry about that. It's not like your loan will start at 8% and go to 20%. Your payment's not going to jump. In that way, it's not going to happen. Basically, if the feds raise rates or lower rates, your rate will also raise and lower, as long as it does not exceed that 2% cap in one calendar year and the 5% cap over the life of the loan. So it's not only that the rate can go up, it can also go down. Now, with the line of credit, because we are in, like, rates are trending down right now. At the end of last year, rates dropped 3 times at the end of the year. The feds have met twice already this year in 2025. They have not changed rates at all, so they didn't go up or down. They stayed the same. But we are expecting 2 rate cuts this year. We don't know when. Like I said, the feds determine that, and when that happens, we just follow suit. If your rate changes, if rates go down and your rate also goes down, you don't need to do anything. The rate will automatically go down the first of the following quarter following that rate change. Okay, so nothing needs to be done. These rates fluctuate with prime, but with those rate caps. So nothing, like I said, the terms do not get out of hand. As long as you make at least your minimum payment, you will be paid off in 15 years, although you can pay extra and pay off early. There is no prepayment penalty for these loans. Okay. There is a small amount of closing costs for the line of credit. Typically $500 to $700, although they could vary depending on your loan amount and your particular situation, but usually in the $500 to $700 range. Okay. I know that the home equity loans that the credit union offers, so the installment home equity loan, those fees start at $1,500. So right now, in this time of stinky rates, the home equity line of credit has the least stinky rate and the cheapest fees. So basically, this loan, the line of credit rather, is the cheapest way to go right now. Okay. Way cheaper than a personal loan, because with a personal loan, there's no collateral, right? It's just, you're asking for, $20,000, and we look at your credit and say, and your income and say, yeah, they qualify for that. And so there's no collateral. So basically, we take your word, you're going to pay us back. So those interest rates are higher because the risk is higher to the lender. With the home equity line of credit, because it's a second mortgage, we do put a lien on the home behind your mortgage. So it's a lien just like your mortgage lien. And so the house is collateral for the loan. So we're able to offer lower rates than personal loans, credit cards, etc., because we do hold the home as collateral. Okay, let's see. No, I didn't want to do that. Did I want to do that? Yes, I did want to do that. Okay. I'm not a techie person, you guys. You'll notice that as the time goes on here. Okay. So how much you can borrow does depend on your equity. Like I said earlier, most lenders do not allow you to borrow all of the equity. And so we need to determine how much of the equity is available to request and therefore borrow. And we will do that all for you here. That's not something you have to figure out. If you don't remember the formula, don't worry about it. That's what we do. Okay. So things to consider, right, when choosing the loan versus the line of credit. The interest rate, they are similar. The home equity loan and the home equity line of credit do have similar rates because they're both second mortgages. However, they do differ a little because the line of credit is a variable rate loan. So those rates tend to be a little less than the fixed rate installment line of home equity loan. So right now, APR on the home equity line of credit is cheaper. Closing costs for the line of credit, cheaper. And the loan is typically if you need to borrow against the equity for one specific purpose, right? We're buying, I don't know, an RV for $100,000. You want to borrow against the equity of the house instead of doing an RV loan. Rates are usually lower on the line of credit or on the home equity loan versus an RV loan. So maybe you want to, you know, borrow against the equity to buy an RV. So it's a one-time deal. You're buying the RV, boom, pay back, make your monthly payments, and you're paying back your loan. That might be a better option for you. The line of credit is used mostly when you expect to need money over a period of time, like very popular right now, home improvements, right? Spring is here, spring has sprung. And so people are wanting to redo their front yards, their backyards, maybe, renovate some rooms in the house. So for that kind of a project, you would need maybe some money up front to get the project started, or maybe you're building a pool, right? So in order to start the pool construction, you have to give some money to the pool company. So maybe they want $10,000 up front. No big deal. The line of credit, you advance your line of credit, the $10,000 that you need. You pay your pool company, and now your payments are only based on that $10,000 that you used of whatever limit you have. Maybe you borrowed $100,000 on the line of credit, right? But you've only pulled 10,000 of it to get your project started. So that's all your payments are going to be based on right at this point, 10,000. So maybe you make those payments for, a month or two or whatever, and then the pool company is like, we need, 20 grand more to move to the next phase of construction. So then you come back to the credit union, you pull 20 more, pay the pool company, and now your balance, your payment now has adjusted to the new balance of the line of credit that you owe. For the remaining term. So kind of like a credit card, like say gave you $100,000 line of credit, home equity line of credit. It's similar to giving you $100,000 credit card for the first 5 years only when you have access to that line. So when you have a credit card and you use 10,000 of your credit card, you're making payments on the balance of your card, not the limit of your card, and that's what the line of credit. Uh, those it's similar to that. Okay. Refinancing. Who wants to refinance their mortgage right now? Nobody, right? Because you're paying your interest rates in the threes or the fours or the twos even. Refinancing at this point in time, probably not the best way to go, because if you were going to refinance that mortgage, your 2 or 3% loan goes to current mortgage rates, which are like in the sevens. So although pulling money out of your house, one option is to refinance your existing mortgage, pull the cash out and redo that loan. This is not the best time to do it. And really, guys, I don't think that rates are ever going to be that low again. So if you have an interest rate of 2 or 3 or 4%, I would never touch that loan ever, ever. I would always go to the second loan, second mortgage on the house, way cheaper. Um, your property is also used as collateral, and you could go to a different lender or stay with the same. But honestly, guys, right now refinancing is not it's not the best time to do it. I mean, if rates were lower than your existing loan, then yeah, refinance, pull cash out. If rates are higher right now than your existing loan, which most of us, that's the situation we're in, I would leave that mortgage alone and go with a separate second mortgage. Okay. So this is kind of touching on the same why you would want to refinance. If you were lowering the rate on your current mortgage, that might be a reason to refinance and pull cash out of that loan. If if it'll lower your payment, awesome. You can access cash equity from a refinance, but like I said, most of us are not in the position right now to drop the rate on our mortgages by refinancing. We're just not, and I don't see it going there for a long time. So, all right. So, factors to consider. What will the equity be used for? A very popular reason why members are getting home equity lines of credit is to consolidate credit card debt. So, with the rising mortgage rates also came the rising credit card rates. If you haven't noticed, interest rate on credit cards that were in the high teens or 20s are now in the high 20s and approaching 30%. Not sure if you realize that, but it's insane, like criminal what's going on with credit card rates. So maybe you done the home project already and you used your credit cards to finance, right? And you're like, oh, these bills are rolling in now. Payments are crazy on these high interest rate credit cards. What we can do is a home equity line of credit. We, the credit union, when we fund the line of credit, will pay off your credit cards on your behalf from the home equity line of credit funds. Then you have one payment with the credit union. Your rates go from teens or 20s on the credit cards down to 7 or 8% and a much lower payment. Like right now, the loans I'm doing to consolidate credit cards, you guys, I am saving members up, depending on how much you owe on your cards, right? But minimally $500 a month in minimum payments. I have also done loans just recently where I have saved members 1,500 a month in minimum payments. So your minimum payments, like you don't realize you get all these cards here, there, and everywhere. You're paying this one, you're paying that one, you're paying this one, and if you add up all those minimum payments, then maybe you're paying extra. But I'm just talking if you're paying minimum payments, those payments add up. They're in the hundreds into the thousands of dollars per month. We consolidate everything into one loan in the line of credit, and your payments go way down because we're able to spread that debt over a 15-year term. So, although, 15-year term is, it's a lengthy loan, I guess, but there's an end point to this loan. Your credit cards, you're paying and you're paying and you're paying, and the balance goes down a tiny bit every 6 months, and it's just, there's no end to it. This loan has an ending 15 years. As long as you make at least your minimum payments, right? You'll be paid off in 15 years. If you want to pay extra, go for it. If you want to pay extra, it can go straight to principal. You cut that term down and you cut the weighted interest that you're paying us down. That if you're in the position to do, that's also a great alternative. So the benefits to paying off the credit cards, you save a ton of money in interest, tons. Home improvements. Um, Doing a lot of home improvements now, like I said before. Some people, though, are also just getting a line of credit as a reserve. Like, oh, I know I have a ton of equity. I think I want to do whatever, 20, 30, $50,000 line of credit and just leave it out there. If you're not using the line of credit in that first 5 years when the line is open, you're not making any payments. You will only make payments if you use the all or part of that line of credit. So that's, let's say an emergency comes up in 3 years. It's there, it's available for you to use. If no emergency comes up in the next 5 years and you never touch the line, you never make a payment on it. It's fantastic. All right, next, let's see. So when you sign your loan documents, well, let me start here. The loan process right now for the home equity line of credit takes about 3 weeks. That is from application to when you are signing. Okay. Application to when you are signing, approximately 3 weeks right now. I've done it in less, I've done it in 2 weeks. I've also, sometimes it takes longer, depending on your personal situation, what's going on. But about 3 weeks from beginning to when you're signing. Once you sign the documents, there is a 3-day right of rescission, and the loan will fund on the 4th business day. What happens when we fund is we will make the line of credit available. Then we will make a draw on the line for those small amount of closing costs I mentioned earlier. So let's say your closing costs are $400. We make an advance on the line for your closing costs. So you'll start out with a small balance on the line. You're not out of pocket anything. You don't have to, pay cash for your fees. You don't have to pull it out of your account. We just draw on the line to satisfy your closing costs. If you wanted to pay that right back, you can certainly do that. And then you'll go right back to the full line of credit available. Or you can immediately start using the money once we fund. And then your minimum payments are based on the balance of the loan at the time the statement cycles. Payments are always due on the 15th of the month with these lines of credit. Always, no matter when your loan funds, always due on the 15th of the month. So we cannot change the due date on these loans, by the way. There is a grace period of 10 days, but, like your car loan, but we don't want to tell everybody that. but there is before late fee is charged. There's a 10-day grace period. Well, let me see. Okay. Next slide. Oh, that was the last slide. Okay. If you are interested in getting more information about maybe your specific situation, what you need the money for, do I have equity? My credit looks like this, my credit looks like that, whatever, you can give us a call. The numbers are on your screen. You can, you can call me directly if you'd like to do that. I believe my contact information will be on the email that you guys will get tomorrow. Or you can call and ask for me. I've been here 100 years. So if you say, I want to talk to Jennifer in home equities, everyone will know who you're talking about, pretty much. Okay. Do we want to ask questions? Karen, what do we want to open? I talk fast, you guys, so this probably didn't take as long as everyone anticipated, but
Yeah, so I think we're now ready to take questions from you
mhm,
guys. In the meantime, I am sharing Jen's email on the chat box. So if you have any questions, let's say, you don't know what you're gonna ask her right now, and then something pops up in the middle of the night, you can just email her here. So also, okay, I guess we have one question right now.
mhm.
Renee, I'm gonna go ahead and allow you to unmute your mic. So, okay, yes, you may go
Hello.
ahead and speak now. Okay.
Okay. So I did call in before and ask because I just started a new job and I'm
Mhm.
getting my second paycheck this Friday. Can I
Mhm.
go ahead and start the process or should I wait till I have that?
You can apply. What we need is 2 full paychecks. So if you're
Mhm.
full time, we need 2 paychecks to show, if you get paid every other week, 2 80-hour paychecks. Sometimes,
Okay.
the first check is a partial pay period, right? Because you started in the middle of a pay period. But once you have 2 full paychecks, that are you in the same industry as you were previous?
Pretty much.
Yeah.
It's
Okay.
all clerical. So
Yeah, that's fine. Yeah, as long as you have 2 full paychecks, uh, we can take that. Do you want to? Okay, here's the thing with these applications, you guys. If you're not exactly ready, if you do not have, like, you won't have your proof of income for a week or so. When you apply for a mortgage product of any kind, there is a clock that starts ticking. These are federal guidelines. We have a certain number of days before we have to send you disclosures. We have a certain number of days before we have to decision the loan, before you have to get an underwriter to look at it and say yes, approved, or no, not approved. So I like to. My preference is to wait till you're prepared. Like if you're gonna have access to it on Friday. Today's what, Tuesday? That's no big deal. But if you will have on Friday your second full paycheck, applying a couple of days before, no big deal. If you need to wait another pay period before you'll have that second full check, I would wait.
thank you.
Okay, you're welcome.
Okay, we have another one. Danette, you may unmute yourself now. You may speak now, Danette. I guess while we're waiting on Danette to unmute their mic, we have one question from our sign-up sheet. So what is the best option for a retiree? Is it HELOC or home equity loan?
I would say that's situational. If you're on a fixed income, depending on how much that fixed income is, it might be safer for you to go with the loan versus a line of credit. But I am going to say this, which I did not mention yet. The home equity loan, the minimum to apply for is 50,000. On the home equity line of credit, The minimum is 10,000. So if you are needing under 50,000, the line of credit would be the only option here at the credit union. 50,000 or higher, you do have a choice to go loan or line of credit. People with fixed income, it would just depend, I guess, on your comfortability. But like I said, even though the rate's variable, it doesn't jump. Your payments aren't going to double or triple, right, from month to month. That doesn't happen. If the feds raise rates, for example, typically it's a 1/4% at a time, maybe a half, usually a quarter, and that, depending on what you owe, may change your payment, like, I don't know, a few dollars, $12, even maybe $20, 20 something dollars. It's not a huge leap in the payment. So if you're nervous about payments, rates jumping and payments jumping, that's not how the line of credit works here. I don't know of any other lenders, you guys, that have rate caps on their home equity lines of credit. To be honest, I just don't know of any. That is a huge selling point here, because if your rate starts at, so Wall Street Journal Prime is what the rate's based on, right? Right now, Wall Street Journal Prime is 7.5%. So that is the absolute lowest rate we would be able to give anybody. And of course, it's going to be based on your credit and loan to value. So does everyone qualify for 7.5? No. Do some people? Yes. But if even if your rates are in the eights or something, like that's a way lower rate than what you would be paying on your credit cards and other things I was talking about earlier. But for example, if your rate starts at 7.5, the highest it could go to would be what, 12.5, which is still less than most other loans, credit cards, personal loans anyway. Other lines of credit, home equity lines of credit, other lenders, the rate can increase and increase and increase if prime increases and just never stop going up. Your rate, does lock in after that 2% cap or 5% lifetime cap.
Okay, thank you
Sorry,
for that,
was that
Jen.
clear? I can ramble, so I'm fine.
Okay, we
Mm-hmm.
have Fleming. You may speak now, Fleming. Okay, while we're waiting on
Hello,
Fleming.
can you
Oh,
hear me?
Oh
yes, we
yes.
can hear
Mm-hmm.
you.
Good evening. I
Hi.
had a question about if your home is in a trust, does that affect um, getting a home equity line of credit, or what's the
Um,
process of that?
we can lend on a home that's vested in a trust as long as the trust is revocable. So if the trust says revocable, good to go. If the trust is irrevocable, we are unable to lend on it. Now, if the trust isn't, I'm sorry, if the home is in a revocable trust and say the trustees are you and your husband, for example, then we would need both you and your husband on the application. So the trustees of the trust must be on the application as long as the trust is revocable. Not a problem.
Okay. And I had another question.
Yes.
A line of credit, do you have to close it, or would a person close it? If you say it's the 15-year um, term, is there a time where a person will close that, or is that advised?
Well, the term of the loan is 15 years. The line of credit is open for the first 5 years of the 15. So once the 5 years is up, we close the line. You don't have to do anything. It just automatically closes. And then whatever balance you owe at that point, you just continue paying for the remaining term. So you don't have to have the line of credit paid off in that 5 years. We don't allow you to have access after that first 5 years, but you don't have to do anything. It happens automatically.
Now, with you closing that, does that affect a person's credit after
Mm,
that?
uh, okay, no, not like you're thinking, because the home equity line of credit is not reported the same way a credit card's reported to credit, right? So that is a revolving line, and if you're maxed out, your score drops. With the home equity line of credit, it's reported as revolving equity, and so that is scored differently. So could it affect it if it's closed out? I mean, minimally. I don't think that would affect it. No. I've not seen that drop someone's score big time.
Do you have any more questions, Fleming? Okay, I think she's done.
Okay.
Okay, we're gonna go ahead with another question here. Agnes, you may unmute yourself now and ask your question. Okay, so while waiting on Agnes, we have one question that came through the chat from
Mhm.
Jose. He asked, how long after a bankruptcy discharge can someone apply for a HELOC or loan?
So that would depend on how long after a discharge. You can apply right after your bankruptcy is discharged. Will you qualify? We don't know. It depends, right? Everyone has a different situation. Um, if you do have a recent bankruptcy, like within, I think it's 3 years, the rate is a little higher if there's been a bankruptcy within 3 years, and the loan to value we allow you to go to is reduced a little bit. So, is there a certain amount of time you have to wait? Not to apply. No, you can apply right after. But once I see, your credit and things and what's going on, if we're not able to do it now, I would be able to tell you what you need to do to get in a position where we would be able to lend to you. So as long as you're discharged, you can apply.
Okay, Agnes, would you try to unmute your mic? Okay, I don't know what's happened, but I think Renee has another question.
Sure.
Okay.
Oh, there you go. I got it.
Oh, there's
Oh,
Agnes.
hi, Agnes.
There was a microphone in there. Okay. So
All
anyway,
right.
I have a HELOC.
Okay.
Once it's paid, do I need to apply again to get another one, or I'm
You have
approved for the same amount?
you have a HELOC with us?
Yes. Uh-huh.
Okay. So you're saying do you have to wait until the line of credit closes before you can reapply?
No.
No.
Because the five
Sorry.
years is over, so I
Oh,
cannot. It's close, and I'm
I
paying on it.
understand. Oh,
But
you can
once,
apply to reopen now. You don't have to wait for the 15 years.
oh,
If
is
you
that
want to,
right?
yes. So what'll
Mm-hmm.
happen is you can apply. So let's say, for example, you had a $50,000 line, right?
Mm-hmm.
And you're paying, closed. You're still paying on you owe 28,000. If you want to reapply for a 50 or higher or lower, really, line of credit, you can do it right now. And what we would do is we would do a new loan and pay off your existing loan
Uh-huh.
so that the 5-year drop period starts over.
Mm-hmm.
So
Okay.
yeah, don't have
Yeah,
to wait at all.
that's good to know. Thank
Oh
you.
my gosh, are you kidding me? There's so many times like, things come up, things break in the house, whatever.
Yeah.
New appliances. Yeah, no, you don't have to wait for the 15 years
Thank
in
you.
order to reapply. You bet.
Uh-huh.
Fleming, do you have a follow-up question for Jennifer? I saw your hand is raised. Oh, okay. I guess she lowered her hand. Okay, so this is a question I think everyone wants to know is
Mhm.
what credit score is required to qualify for a HELOC?
Minimum is 580. Minimum is 580. I mean, if you're hovering around 580 and you want to play, you can certainly do that. We don't really decline the loan because your score is not a 580. But if it's below 580, we know there's things going. We'll be able to see too. There's things going on the credit that might preclude you from being approved. But I would 580 is a good mark. By the way, you guys, we pull Experian credit report only. We do not pull all three. We do not use TransUnion or Equifax at all. And we don't do the three and then use the middle score. We don't do that. Experience the credit bureau we use.
Okay, and we have another one. They're asking, can you do a HELOC on a home bought with rent to own?
We will do a line of credit on a rental home or investment home if the investment or rental home is a single family residence. We are unable to lend on investment property that's a condo or a townhome. It has to be a single family residence. Now, your primary residence, if you want to borrow against that, we could do a single family residence, we can do a condo or a townhome. But on the rental, single family residence only. We also do not lend on manufactured homes. We don't do home equity lines on those.
Okay, so going back to the credit score question, Renee asked, does the rate go down if credit score is higher?
No, the rate follows prime only. So if you think you have a significantly higher score than you did when you got the loan, for example, like 3 years later, maybe you want to call and say, hey, let's try to do a little increase. Then we would reset the loan. The new loan would be at the new rate you qualify for. But other than that, like you guys, if your rate's like 8.5%, and your credit score goes up, and puts you in another tier of rates, the lowest rate is 7.5. So it's nothing. It's not a huge difference. Like all of these staggered rates, these risk-based lending, it's a quarter, half, maybe 3/4 of a point difference as your credit score is higher. It's not huge, but you can reapply for the loan, reopen the line for another 5 years at the new rate. We could try that.
Okay, and then someone asked, what are the pros and cons of a HELOC versus a home equity loan?
Pros and cons of a HELOC. So you have access to the money for 5 years in that you don't have to use it if you don't need it. For the home equity loan, it is an installment loan, meaning we give you all of the money up front when the loan funds, and you're making payments on that entire amount, whether or not you've spent the money. For the home equity line of credit, you can just leave it kind of out there and available until or unless you need it. So if we set up the loan now, you got a $20,000 line of credit. You don't really need it for anything. It just kind of sits there. Maybe in 3 years, your water heater goes. You want to pull money off the line of credit to pay for a new water heater or an appliance. There is no, you don't have to use it. We don't require an advance. Some lenders do. We don't. So it can literally just sit there if and when you need it. If you're not using it, you're not making payments on it. That's the best part, I think.
Okay, do we have more questions in the group? I encourage everyone to take this opportunity to ask their questions. We still have like 30 minutes of our time, so whatever questions you may have for Jennifer, please feel free. And then, so while we're waiting for people to ask questions, is a property appraisal required for a HELOC? Who schedules it, and how much does it cost?
An appraisal is not necessarily required. Um, if we do require one on your particular situation on your home, uh, the credit union would order the appraisal. You're not able to choose your own appraiser, and neither are we. We order it through an appraisal management company, and they pull out the orders. So we don't know who your appraiser is. We're not allowed to know who your appraiser is, and neither are you. But it's not necessarily required, no.
Okay. Um, and then one more. Are
Mhm.
there any financial benefits for seniors when taking out a HELOC?
The financial benefits, if you're consolidating debt, that's huge financial benefit, right? The interest on the loan, the interest that you've paid on the line of credit can be tax deductible. You are ask your tax professional. I'm not allowed to give tax advice, but it may be tax deductible, the interest. That's a financial advantage. Uh, but like I said, if you want to just contact me, privately, not in this group setting and tell me your situation, I would be able to tell you exactly which way is best.
Okay. We have
Mhm.
Agnes that raised her hand. You may speak now, Agnes.
Okay, Jennifer, will you
Yes.
have future webinars regarding reverse mortgage?
The credit union may do that. That is covered in an entirely different department.
Mm-hmm.
So it would, if it would happen, it wouldn't be me, but uh, possibly. I don't. I don't know the answer for sure.
Yeah, because somebody's talking to me about it, and I don't really want to do anything
Well, if
until
you,
I actually understand what it is.
well, that's smart. I wouldn't either. You can research online. You can go
Mm-hmm.
to your financial advisor if you have one, maybe
Mm-hmm.
even your tax professional. But yeah, I would not. Someone wants you to do that,
Yeah, yeah.
like like a company is trying to get you to do that, or
Well, yeah, actually, a friend of mine
oh,
was
I see.
is doing that on her
Mm-hmm.
job, but
Mm-hmm.
I don't. I'm afraid, like I said, because I don't know much about reverse mortgage.
Yeah,
Yeah.
I would not enter into any kind of contract that I haven't researched at all. So
Hmm.
do some
Yeah.
research online and reach out to professionals to
Uh,
mhm.
Thank you.
You're welcome.
We have another question that came through. Is they're asking, can you fund a second home purchase with a HELOC?
I have done home equity lines of credit for the purpose of buying another home. Yes, you can use the money. You can use the money for anything, you guys, really. Um, so if you want to borrow against your house to purchase another house, yes, you can do that for sure.
Okay. Um, do we have any more questions in the group? We still have like 15 minutes of our time. Do you have anything more to add, Jennifer?
I mean, if you guys want to just email me or call, it's for so we can discuss your particular situation and what might be best for you. You can feel free to do that if you're not willing to lay it all out here now, and I get that. So,
So, okay, we have one person typing. Oh, they said thank you, Jen. He'll be
oh,
applying soon.
oh, great, yay! So if you guys end up applying online, you want to go to the website to submit the application. There's a section of the application for comments, and so just note something about the webinar that's where you heard about it, you learned some stuff about it, and that's why you're applying, so that I can kind of take note if you were present during the webinar and ended up applying. That would be nice to know.
Okay, sorry. Also, we have one more that came through.
Okay.
Um, do you offer home improvement loans without the house as a collateral?
Well, I mean, that would be a personal loan, basically. Um, yeah, we don't have home improvement loans per se. We have loans we use for the purpose of home improvements. One could be a personal loan that does not use the house as collateral, and the other would be the home equity line of credit that does. But you can borrow against, if you have a clear title to a car and you have, it's worth what you need, you can borrow against that to with that, and that's not using your house as collateral. But lots of times when you need a larger dollar amount, the house is the cheapest way to go. And don't be afraid to use the house as collateral. Your first mortgage used your house as collateral, right? And we don't want to foreclose on your house. So if you don't pay us ever, could we foreclose? Yeah, but it's not something we like to do. It's expensive, it's sad, it's all of the things. So but if you're afraid to put your house up, no pressure. You can try personal loan. Like I said, there's other companies that will that really specialize in just larger personal loans if you want to go that route. But it's expensive, but it's out there, so for sure you could try it.
Are there any age limits to qualify for a HELOC?
Not that I'm aware of. Like you have to be at least 18 to be able to sign a contract, a loan contract, but other than that, no. No age. We are a equal opportunity lender. We don't discriminate on age. So there's no restrictions.
Okay, do we have any more last questions? I think we have everybody answer their questions, but if you do have any, please, this is your chance. We only have like less than 10 minutes before we end. So, yeah. Do you want to leave your direct line, Jen, so that people can contact you or
uh, yeah, we can
email?
do that. Well, email to contact me. I'll call you and we'll discuss. Email's going to be easier way to get a hold of me because I'm in like a phone center, so we're constantly on the phone. But if you email me directly, I will call you. That'd be a better
Okay,
way. Yeah.
perfect.
Yeah.
Okay, I think we are good to end the webinar if you don't have any more questions. I know it's a lot to take in, a lot to remember, but don't worry. Our line is always open. You can contact Jen at her email or the credit union's direct line, the
Hmm.
702-228-2228. And then everyone will have a recording of we'll send a recording to everyone that attended the webinar, and we'll also include free resources that hopefully will help you decide on HELOC. Do you have anything more to add, Jen, before I end it?
No, just call me if you guys want to discuss your situation. Just or email me, I should say, and just let me know you want to discuss, and I'll call you. No problem.
Okay, perfect.
Yeah.
Like again, everyone, thank you for a very insightful webinar. Hopefully, every one of you had a chance to, you know, get a lot of knowledge, get a lot of, resources for you to decide whether HELOC or home equity loan is perfect for you. Thank you again, and I hope everyone will have a good night. Okay, thank you,
Thank
Jen.
you.
Bye.
Bye.